welcome to Market Domination, sponsored by Tasty Trade. I'm Julie Hyman, that is Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
If you're really trying to be strategic about it, you really have to pay attention, and you got to listen to what the forward guidance is and who's giving the upbeat guidance, who's giving what they think is more realistic. Even if it's a softer guidance, it's got to be more realistic. So you kind of have to do your homework. You have to listen to what they say. You have to understand the sector you're in and where you're looking to put that money to work. But I think there's still a lot of opportunity out there, but I'd like to see the market pull back.
It's not just that you have tariffs, it's that you don't know what's going to happen next. There could be retaliation, there could be additional measures, and that further weighs down on investment and global activity. And you put these two things together, and the impact on the global economy is quite sizable, about 0.5% of global output that would be lost by 2026 if we have this escalation in trade distorting measures, tariffs, etc. So we're certainly concerned about that and concerned that it might hurt everyone.
We're building vehicles that customers are flocking to. We're picking up share. We're discounting less than most of our competitors. And that's been a consistent theme for the last several quarters. So we're just excited about the momentum we have in the portfolio, not just in our ICE, but also in our electric vehicle portfolio and what we're building there as well. So I think there's a lot of things that are going for us, but most importantly, it's keeping the customer at the front and center of everything that we do.
We've got 1 hour to go until the market close. So let's take a look at the major averages here. After starting the day negative, we're seeing kind of a move upward here, although the Dow is going sort of back to the little change line now, up just about 4.5 points, not even a hundredth of a percentage point is where we are now up. The S&P similarly little changed, as is the Nasdaq. And we talked recently about how now that we're in the thick of earnings season, it's sort of more micro-driven than macro-driven. That seems to mostly be the sense once again today. If you look at trending tickers, for example, you're going to see a lot of earnings-related movers. General Motors up 10% on its earnings. GE Aerospace down 9% on its earnings. Lockheed Martin down 6% on earnings. Philip Morris up 9.5% on earnings. So you get the idea. When you have all these individual stocks moving on earnings so much, it equals not that much on the index level. So that's kind of what we're seeing big picture here today.
Some big earnings on deck, of course, as well. Let's talk about yields, too, because that is the big story today. It kind of moves there, making a lot of attention. At least in part, Julie, we were talking about this. What we got is improving economic data and a bet that maybe Jay Powell and the team may be less aggressive going forward. Yeah, this move has gotten a lot of attention, not necessarily just today, right? But let's look at, say, the 1 month chart that we've seen of yields. Yeah, look at that. And the big push upward. And by the way, this is happening not just in the United States, but it's happening in bond markets, sovereign bond markets, that is around the world, where we're seeing these yields push up as the perceptions are starting to shift about what the Fed, which is, of course, the sort of premier central bank in the world and kind of the tail that wags a lot of other dogs, what they're doing. The perceptions have been shifting. I have good news. We have just the guy to talk about this. We really do. So for more on the latest moves in the market action, let's welcome in Rick Reeder now, BlackRock Global Fixed Income Chief Investment Officer. Rick, it is great to see you. So let's start right there, Rick, what we're talking about with Julie and the move we're seeing in the 10-year. Rick, what do you make of that? What is driving this?
So a couple of things. Like you say, the data's been stronger. I mean, across the board, the data has been pretty solid. I think at the end of the day, the market's completely overshot. I think last time we were on the show, we talked about satellites don't land. Everybody's talking about hard landing, soft landing. Service economies don't really come under that much pressure. And the market's got way askew on this idea that we were going to hard land. Fed's got to cut rates dramatically. We're going to get to a 270 funds rate by the end of next year. Now you're seeing the significant recalibration back. Listen, I think, quite frankly, we've done most of the move. I certainly think in the front end of the yield curve, we backed up 70 basis points. All of a sudden, the front end of the yield curve provides some real value. And so we've started to add some of the front end. So we were so skewed the other way that you're getting some recalibration. Now, you've also got some election dynamics at play where people said, gosh, we're going to have faster growth potentially. And so people are pressing it. So listen, I think it's one of the opportunities. We're talking about income is still doing really well. It's a question of, is there a big rate trade this year? I don't think it's a big rate trade to make money on this year. Or now we're probably into next year.
So Rick, if things have sort of run too far here, then what's fair value on the 10-year right now?
So if you said to me, I think I said the same thing last time. If you said to me, the 10-year in the mid to high threes to to 4.25, 4.30, I think that's where we are. And so I think that's a bent towards, could we be lower by the end of the year? We've seen, per the earlier part of the conversation, a spate of good growth data. It tends to mean revert. And so I still think if you said to me, nominal GDP in the United States is where the 10-year tends to set. If you said to me next year, we're going in an environment, which we believe is right, 1.5 to 2% growth, 2%-ish, maybe a little higher inflation, that gets you to 4% on the 10-year. I don't think anybody's going to make a lot of money on the 10-year note next year. I think you make a lot of money in income, but not in.
Sorry, Rick. On the flip side, you have the folks like over at T. Rowe saying 5% we could see on the 10-year 6 months from now. Does that seem out of the question to you?
Nothing's, depending on what policy is, we're going to see some evolution in policy. Depending on what policy is, could rates move higher? They definitely could. If you said to me the base case today, I still hone in around this 4% level. We got to watch inflation like a hawk. There's tremendous amount of spend in AI, in data center, in clean energy. Could you press inflation a little bit higher? You could, but it's not our base case. But part of my argument is similar. Like, you look at what's happened year to date. Why would you own the back end of the yield curve and take all that interest rate risk? Just sit in the 2 to 5 year part of the curve, clip a bunch of coupon things like credit, securitized assets, and you look at high yield this year, still up 7.5. The ag's now, 2.5 to high twos. Like, that's the trade, and you don't need long interest rate risk.
Is there a level, Rick, on the 10-year that you're watching where it becomes, you think, a potential challenge for the equity market? I know some strategists, for example, are calling that 4.3.
No, first of all, if you think about the big, what drives the equity market today, we know Mag 7, those companies don't finance. In fact, they're net long cash. So there's no certain number that is, we have an economy that's 70% services, not interest rate sensitive. Manufacturing, look at the jobs report last month. You just had a couple of weeks ago, you had 223,000 jobs. I think 203 of it was in services, not interest rate sensitive. So I think when people put those numbers on it, first of all, there is no algorithm that gives you that number. And so, yes, I think the equity market can absorb an awful lot of that rate like it already has. And that I just don't think interest rates used to be an incredibly important tool for the economy. Inverted curve meant recession. It doesn't anymore. Banks don't finance that way. So I just don't think it's that critical. What is more critical, the amount of cash that's sitting out there in the system is epic. There's $9 trillion in global money market funds. There's $23 trillion including deposits. Some of that's pledged. And you don't have any sellers of equities. Companies buy back $1 trillion of their stock and you don't have any net sellers. If you said to me, interest rates are technicals, I'll take the technicals all day. I think the valuations of equities are too high, but I think the technicals are impressive. So I think equities will do their job.
Rick, we're talking about the Treasury 10-year here, but Julie brought up a good point. It's a global dynamic we're seeing right now. What does that tell you?
So a couple of things. One, I think I think what Julie said is right. The Fed sets policy for the world by and large. ECB is important. Bank of England's important. Bank of Japan's important. The fact that the Fed's not going to cut, the markets got way ahead of themselves. That's pressured rates around the world. There's also been, this idea around growth, deglobalization. What does that mean? And that's pushed rates back across the globe. Quite frankly, I think places like Europe and UK are better places. The growth is slower. You don't have significant policy change in terms of an election, et cetera. I think, we've oriented more of our exposure to Europe and UK, where I think interest rates will be much more contained. And, so you don't have this volatility going into the election.
Rick, I guess this is the day of me quoting other firms at you. I mentioned T. Rowe. Goldman Sachs's call is getting a lot of attention, that they are looking for sort of compound growth rate for equities, U.S. equities, over the next 10 years of only 3%, which is below the long run average. Does that make sense to you, given that outlook that we have for the economy?
They're pretty good. That's a surprise. I haven't seen that report. Listen, if you take in the last year or so, The ROE, the return on equity for the equity market, has been about 18.5%. That's unbelievable. Are we going to see that, huge amount in tech, huge amount in AI, or the beginnings of AI? If you said to me the next few years, companies will compound our return on equity at 10 to 12, that seems okay to me. And if you believe the economy is going to get this big boost from infrastructure spend, et cetera, I don't know. That number seems pretty low to me. I'd have to read that report. Is that?
I'll send it to you, Rick.
Yeah, no, that'd be great. That seems pretty low. Particularly, listen, it's pretty hard. Automation is changing the world. We don't know deglobalization, but gosh, the vision you could have for the next year or two is the pretty good numbers in terms of where ROE is and where companies throw off book value accretion. I don't know. I think you'd have to be pretty bearish about the 2 + 8. To come up with those numbers.
Rick, let's talk about the election. We're only a couple of weeks out now. Headline in the FT this week that got some attention. Your CEO, Mr. Larry Fink, the outcome of the U.S. election really doesn't matter for financial markets. What do you think? You agree with Larry?
Oh, he's a smart guy. I would say, listen, I mean, I think there's a short-term and long-term dynamic, or intermediate-term dynamic. I think in the short term, markets are going to gyrate. There's no question about that. There are all sorts of every meeting I go to, people want to describe this policy versus another. What is corporate tax policy? What going to be? What are tariffs? What are we going to do across broad taxation, corporate, personal, et cetera? So. Near term, I think is going to be a reaction. I think what Larry's very right about is at the end of the day, depending on what the Senate looks like, et cetera, policy probably won't radically change. And that at the end of the day, if you're invested in the right businesses, the right companies, the right rate structure, I've said this for years, like markets and the economy are incredibly resilient to policy, unbelievably resilient to policy, good policy, bad policy, market economy, this market, U.S. economy particularly, incredibly flexible, energy independent, technology proficient, education oriented. It's pretty hard to run against it.
Well, and Rick, as we've talked about before, you kind of, have your two different hats as sort of that long-term secular investor hat, and then you have your trader hat that you also put on, where you try to be a little more tactical in the short term. Is there anything you're doing leading up to the election, and is it changing the closer that we get in order to sort of position around it?
Yeah, the big ones are one. We've brought down a bit of our interest rate exposure, but we bought some front end on the back end of the curve, on the back of this backup that you've seen in interest rates. We're running a lot. We're running moderately long equities, but gosh, the volatility in the equity market is to buy volatility in the equity market is crazy cheap. So we've added a lot of convexity to the portfolio through equity. So what happens is we de-risk pretty quickly, and then we're in. Per that comment before, in stocks, I like these big durable companies with big cash flow models that are almost regardless of policy, will keep doing their things. Tactically, I don't love like we big cap versus small cap. Like I like the big, generally in big cap, the ones that are in data generally, and we're doing nothing but growing that. We love income. We launched this ETF called BINC that's done pretty well. It's gotten a lot of inflows. Income is where people, because rates are where they are, and I would still say the Fed's still got to cut to get on the right curve relative to inflation. You can clip 6.5%. 6.5% income without taking a lot of risk. You don't have to go out the yield curve. You don't have to go into exotic emerging markets. Put down the fairway, parts of high yield, securitized assets, investment grade credit, Europe, where it's great to be a lender in Europe where the yields are high relative to growth. So I just think it's just let's keep, and we keep optimizing what we're trying to own in terms of income. But that to me is the trade, and it'll keep working.
People love clipping that coupon. Rick, thank you so much. It's always great to see you. I appreciate it.
Thanks, Julie. Thank you.
And by the way, we look forward to talking with Rick even further. That's at our Yahoo Invest Day, Yahoo Finance Invest Day, Tuesday, November 12th. It is our big annual conference. Rick will be just one of the fabulous guests that we and you will be hearing from on that day. We're just getting started here on Market Domination. Coming up, big tech is going nuclear, but will it be enough to power AI? We'll hear from the U.S. Energy Secretary Jennifer Granholm on the other side. Plus, earnings season is in full swing. We're breaking down the latest from Verizon, Kimberly-Clark, Lockheed Martin, and many more later in the hour. Stick around, we've got much more market domination still to come.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator.
Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Now time for some of today's trending tickers. You can scan the QR code below to check out the best and worst performing stocks of the session on Yahoo Finance's trending tickers page. Starting first, with Verizon. The telecom company reporting a revenue miss for the third quarter. Verizon also revealing expectations of $17.5 to $18.5 billion in capital expenditures for 2025. The big problem at Verizon, it's not selling enough phones. Apparently, that was what was the shortfall came from this quarter. The company signed up more phone users than analysts had expected, to the tune of 239,000. but didn't sell as many phones to them.
Yeah, analysts at Bloomberg who cover this one saying the downturn in equipment sales is tied, they say, to a lack of compelling new hardware features from the smartphone makers, leading to a marked reduction in switching and lower churns. Of course, we all think about Apple's new iPhone lineup, what kind of iPhone upgrade cycle that is exactly going to kick off. But this is one of the first three major carriers, right? I got Verizon, now I got AT&T and T-Mobile on deck. They're going to be reporting tomorrow.
Yes, exactly. And by the way, Verizon has underperformed AT&T and T-Mobile this year. It's been the laggard, although it is up in the year, but it's not up as much as its
trailing those rivals.
Yeah.
All right, next up, take a look at now shares of Kimberly-Clark. That's after missing revenue estimates for the third quarter. The company also lowering its full-year outlook on organic net sales. We're down about 4% right now, so lowers its full-year organic sales forecast, expected to rise 3 to 4% this year. That is down from a previous forecast. Company talked about headwinds from changes in retail inventory levels. Stock had enjoyed a nice gain this year, but down right now.
Yes, exactly. And, when you look with the analyst commentary around this, it seems to have a lot to do with supply chain, and they're sort of grappling with supply chain adjustments here. And apparently, according to one analyst over at Barclays, the retail inventory destocking is continuing. And in particular, the professional business might see more sluggish demand. The stock is up about 14% or so year to date. It's kind of in the middle of the pack within the consumer staples space. Well, big tech making big bets on powering artificial intelligence. Two nuclear energy CEOs who made deals with Google and Amazon both recently joined Yahoo Finance, weighing in on the importance of the shift to nuclear.
The need for power, particularly for data centers, has kind of changed the dynamic really in the last year to year and a half from where it was. It's kind of changed the landscape for energy. We've kind of gone from kind of a stagnant growth to really kind of needing a lot of new capacity.
And the big news from last week was not just Amazon saying, if someone else builds it, we will come buy the power. Amazon said we are prepared to invest hundreds of millions of dollars in the construction of these plants. That's the game changer, and that's what's really going to facilitate this new build era.
And the U.S. government is jumping in to the tune of up to $900 million in grants to support some of this development. Joining us now, Energy Secretary Jennifer Granholm to talk more about this. Secretary Granholm, thank you for being with us. We have been watching this nuclear trend quite closely here. A lot of these projects are long-term. They're years out. So how are you thinking about strategically how they should fit into the energy picture, particularly with all of this need to power AI data centers?
Yeah, first of all, we know that AI data centers are being built, and they're not going to happen overnight either. So a lot of the hyperscalers, as we call them, are doing power purchase agreements with utilities to be able to get them across the finish line. But ultimately, we want the data centers to be powered by clean energy additional to what is already on the grid. So we're telling the tech companies to BYOP, bring your own power. Many of them have committed, all of them have really committed to clean power. So that's very exciting. Nuclear power is clean. And they're very excited about these small modular reactors. You had the Kairos CEO on. He has a small modular next generation reactor. And those are able to attach essentially to a data center, or at least be virtually connected to a data center to be able to power that center with clean base load power, not intermittent power. And so it's very, we're excited about this movement.
And Madam Secretary, why is it taking so long, so many years to bring these reactors online? And do you think there's anything regulators can do to step in, help speed up that process?
Well, it is true. The Nuclear Regulatory Commission is really working on streamlining the process, but it's less about that so much as it has been about people willing to place orders for these small modular reactors. We just had a couple of reactors come online in Georgia. These are the big reactors. They're called AP1000s. And people were watching that, but it's hard with new technology to get to commercialization unless you have an nth of a kind experience. And so nobody wants to be the one to buy the first one. Well, if all of these tech companies sort of band together and not ask for different designs from different, different specifications, but if they can agree on basic power, then you can order a 6-pack or a 12-pack of these small modular reactors to be able to power your data centers. Many of them are interested in that, and they're now starting to do that. These announcements that you've seen over the past couple of weeks, amazing, not just with Kairos, but you've seen Google also and Microsoft, with 3 Mile Island. And these, I will say this, these hyperscalers are also partnering on other kinds of clean energy, like geothermal energy, which is the heat beneath our feet. I was just in Texas, and Google is also looking at solar, and they will pair that with batteries eventually. So all of these different experiments are happening, but there is a real consensus among these big tech companies that they should be bringing their own power with them.
Yeah, it definitely seems to be an all of the above approach when it comes to the kinds of power that they're drawing from. Just want to linger on nuclear for one more moment, though, because the small modular reactors, there is some skepticism around them. Maybe partly from a science perspective, but it seems like more so from a cost perspective, because nuclear historically, the big scale nuclear that you were talking about, has been so expensive and has taken so long and has been so difficult to build. What's your level of confidence that these SMRs are going to be realistic and viable, and sort of what's the administration willing to do to help that along?
Yeah, I mean, this is where the role of government is so important, right? In early stage technologies, partnering to be able to bring down the capital costs of these investments. We are less concerned in traditional SMRs about the technology, more concerned about getting orders placed. And once you do get a couple of them built, then really the nth of a kind where you can really take it to scale, that happens. So all of this demand is occurring right now. And so we are grateful to the hyperscalers that are willing to take a shot at going nuclear with some of these SMRs. That will bring down the cost of the technology as long as we can scale it.
How comfortable do you think Americans are having these reactors in their communities? I'm curious about that. Whether you think actually there might need to even be some kind of education campaign to get Americans comfortable, to convince them that the technology is safe, secure.
Yeah, it's such a good question. We have a gold standard in the United States for nuclear safety. And the Nuclear Regulatory Commission, one of the reasons why they do take their time in licensing is because they want to make sure it is safe, and they should. But with respect to communities, every community is going to be different. There are some communities that are comfortable with nuclear because they've got some of these big reactors. In fact, we have about 94 big reactors in the country on about a little over 50 sites. On those sites, there's plenty of room for more reactors to be built, whether they're small or large. They may be already permitted for large or small reactors. That will cut through the red tape like this. If you can go to a site and build on it and it's adjacent to transmission, that is why we're telling the data center companies that we can help provide sites. They can get extra tax incentives if they are part of a former energy community. You can get, like, basically if you buy one SMR, you can get the second one for free, essentially, based upon the tax credits of location and production of nuclear energy in an former energy community, maybe attached to a former coal plant. There's a lot of incentives to make this happen.
Finally, just to broaden it out a little bit, because we are expecting this big uptick in demand because of data centers, among other things, how concerned are you that the sort of energy transition is being delayed to some extent? I mean, we're talking about all these renewable sources, but there's also a big need right now. As we know, oil and gas industry in this country is producing at record levels, in part to try to fuel some of this natural gas, a big part of that. So how are you thinking about where we are on the timeline versus where you might want to be?
It is amazing what is happening out there because of the Inflation Reduction Act. So this year, in 2024, we will basically be adding 30 Hoover Dams worth of clean power to the electricity grid because of those incentives that are making it irresistible for developers to get clean generation on the grid. That is twice as much as last year. That broke a record last year. It's breaking records this year. It's going to do the same next year. The trajectory for the next 10 years, because of the Inflation Reduction Act, is very encouraging. So I'm not worried about us being able to add the power that we need. I want to make sure we've got the transmission grid to take that on, and I'd like to see more types of power like nuclear.
Secretary Granholm, thank you so much for joining us today. We appreciate your time.
You bet. Thanks so much.
Coming up, Citigroup updating its ratings on some solar stocks. We're going to check in on our top analyst calls of the day when market domination returns.
Goldman Sachs recently forecasting lower S&P 500 returns over the next decade compared to those of the last 10 years and really historically as well. But the firm is making the case that its outlook is not as bearish as it may seem. Yahoo Finance's Josh Shaver joining us now with more. And Josh, this call got a lot of attention because it did seem sort of pessimistic, but you got a little sort of nuance from them directly.
Yeah, so to give us the numbers here, right? So the 10-year annualized return over the last decade was 13%. That's slightly above the average annual you would get in the S&P 500 on any given year historically, which is 11. Goldman coming out and saying, due to high concentration in the market right now, that's the key factor here, they're projecting that over the next decade, the average annual return will be 3%. Now, I saw a lot of bearish sort of framing articles around this, and we talked to that team at Fairmount, and I said, you know, they're pretty constructive on equities. I'm curious what they're actually saying here. So I talked to Ben Snyder, who's on the team with David Costin over there, and he emphasized that overall they remain confident in the equity market, right? That's the broad takeaway here. They have a 12-month target of 6,300 on the S&P 500, That's higher than we are today.
Yeah.
But what he said is the key part that normally happens when we get to this high concentration level, they're sort of those Mag 7 stocks, the top 10 stocks all being the market, some shock eventually comes. And he said when you zoom out over a 10-year period, it's hard to have look into what that shock could be. And so he said, right now we don't see a shock. That's why we feel good about stocks over the next 12 months. History would tell us, though, zooming out over the next decade, you are rather likely to get some sort of shock that would unwind this, perhaps, I'll use the word bubble here, they didn't use it, but perhaps the percolating bubble we've been talking about. When you introduce some level of shock, that's when your bull market ends. You get maybe a year or two of a significant bear market. Then we average out that 10 and we get to 3%.
Is it, so it's concentration and it's potential shock, but is it also, and I haven't read the note yet, Josh, but is it also just mean reversion they're bringing up as well?
Yeah, so Josh, if you ran the numbers, right, and we did 13% for 10 years on average, and then you do 3% for 10 years on average, you come out to something closer in the 8% range over a 20-year period, which again, if we study the S&P 500 over a 20-year period, that's not that far off from average. So there is an aspect to that where they sort of say, okay, you kind of can't expect this forever. And I think what Ben told me is that's kind of been the takeaway as he's talked to investors talking about this note, saying 3% over the next decade, what are we talking about here? The takeaway being just don't expect the S&P 500 to rip the way it's ripped the last couple years in perpetuity here. You're going to get your job back.
Well, I mean, as you said, there was some pushback against
Yes.
it. One of them came from Nick Colas over at DataTrack, and he basically took a chart going all the way back to 1938 and looked at rolling 10-year periods and the compounded annual returns. There it is. The bottom dotted line there is 3%, the number that that Goldman's talking about. The top line is the average over that period, which is 10.6%. You said the average over the last 10 years is 13% or so. It's 10.6% over the longer term. And what Nick said was, he said, things tend to get really bad before this happens. History, he says, shows that 3% returns or worse only come when something very, very bad has occurred. How bad? Well, we're talking about the Great Depression. We're talking about the financial crisis. We're talking about the oil shock in the 70s. So, yes, something like that could happen.
Something like that could always happen, though.
But he doesn't seem to think that it is that way.
And he also made the case in that note, too, and this is sort of what the team over at JP Morgan Asset Management said at a roundtable I was at yesterday when they were asked about this, is if you really believe in this AI trade and you believe in this AI trade beyond the hyperscalers, then you're probably going to get good returns in the S&P 500 over the next decade because it's going to feed through to your 493 like we've talked about a lot. And if someone else becomes a key player in AI, this is specifically what Nicola said, wouldn't you think it's probably an American tech company?
Right.
If AI is going to be the trade and disruptive tech is the trade, the past several decades of empirical evidence tell you that's going to be a U.S. tech company. Where's a U.S. tech company going to be? The S&P 500. That's how you get your returns.
Makes sense.
We always spin it positive, Josh.
Totally.
No 3%
You have
returns.
to.
Come on.
You have to. Joshua, thank you. Appreciate it.
That's like now the don't say that out loud.
Checking on a few more trending tickers here. You can scan the QR code below to check out the best and worst performing stocks of the session on Yahoo Finance's trending tickers page. We're starting with shares of Lockheed Martin. They are sinking here, down about 6% after reporting third quarter earnings. Company's revenue missing estimates. So Q3 revenue swinging a miss there, Julie. Looks like aeronautical sales dropped 3%. Bloomberg saying here that deliveries of its next-gen F-35 fighter jet, that came in lower than anticipated. We should note the company did raise its outlook. Backlog hit a record. Sales did rise for its tactical and strike missiles, warfare sensors, helicopters. But listen, down in today's trade.
Yeah, it's the F-35. That's what this seems to be all about, according to analysts here. The company shipped 48 F-35s, but it's trying to ship 75 to 110 by the end of the year. It was 48 in the quarter, I should say. And the Government Accountability Office just said that the military spent $12 billion on this thing and that it is not up to par. It failed to meet minimum combat readiness rates for 6 straight years. You even got a couple of congressmen agreeing from different sides of the aisle to lead a commission to sort of look into this. That's Matt Gaetz of Florida and Seth Moulton of Massachusetts. They're going to introduce a resolution to say that Lockheed Martin's in breach of contract and that they want to dig into this more. Now, whether that goes anywhere, we will see, but it seems like the sentiment surrounding that particular product is negative right now.
Yeah, I'm just looking at RTX. It was actually flat here, though they did raise their full year profit and sales targets above consensus, it looks like.
Yeah, speaking of defense contractors, let's also speak about automotive parts makers. Shares of Genuine Parts getting clobbered today after reporting third quarter earnings. The company, the parent of Napa Auto Parts, missing on earnings per share by a large margin here. The company blaming Europe in part, blaming its industrial business in part as well. A lot of the other auto parts makers and retailers are also falling in today's session as a result.
Yeah, I see some analysts cited saying, not really a whole lot for bulls to latch onto here, Julie. Industrial sales missed, European trends soft, U.S. declines. Others noting the revised guide suggests the fourth quarter will remain under pressure. The U.S. auto comps profitability, they told clients, it's really, in their opinion, the biggest disappointment.
Yeah, and just to mention the numbers, sometimes we talk about the big picture, but the numbers here are pretty dismal for the full year. They cut their earnings per share forecast. The minimum had been $9.30. Now the maximum is $8.20 for adjusted earnings per share for the full year.
Yeah, stock down almost 20% here.
Yeah. Let's get to our call of the day as well here, sponsored by Tasty Trade. Citigroup updating its ratings on some solar stocks, and in particular the note highlighting the election's impact on the industry. First Solar getting upgraded to a buy here, with the city saying that people are worried about a guidance cut in the third quarter and the higher perceived likelihood of a Trump victory. But they say, First Solar is kind of priced in this stuff at this point, and that they think that investors have already cut their expectations for the third quarter, so that too is priced in. So that stock rising today.
Yeah, and then the downgraded Canadian Solar. Did you see that one? They went to sell, saying that it will a different set of challenges there under either administration. They told clients Republican win they think would likely increase the risk of more tariffs. A Democratic win will likely raise capex, so they go to sell on that name.
Yes, let's talk about another stock that we are watching closely today. After a summer of turbulence, improving revenue, lower fuel costs, and positive earnings reports have the airline industry hoping the rest of 2024 and 2025 will be a smoother flight. But who are the real winners in the sector? With just a few minutes left until the closing bell on Wall Street, we're looking at how to play airline stocks with the Yahoo Finance Playbook. Joining us now, Connor Cunningham, Melius Research Director. Connor, we've heard from some of the airlines already. And it really seems like, as you point out in your note, that capacity control is the name of the game here, as it kind of always is when it comes to the airlines. And do you think broadly the industry has been doing a decent job at navigating capacity and therefore holding on to some pricing power?
Yeah, so we're always skeptical of the industry talking about cutting supply. Like you said, it's always about supply at the end of the day. But this time it feels a little bit different. You have Southwest out there talking about core growth down about 1.5% next year. So it seems like there are opportunities to continue to slow. Spirit has talked about shrinking by 20%. It seems like the entire industry in general needs to really focus on profits. And the way that you get there is by slowing growth and reconfiguring your network and figuring out who your customer is and what product you want to sell them going forward. And as they do that, as they focus more on profitability, the supply side of the equation should be in their favor at this point. This all harkens back to the idea that in 2012 to 2014, Southwest, slowed growth for a long period of time, and over that time period, the overall margin profile of the industry doubled in each year. So if we can continue to go back to that type of playbook, that's what I think the bulls are looking for in the market today.
Connor, all this drama at Boeing, by the way, how has that impacted your coverage universe?
Yeah, always something in the press. But yeah, I don't know if it's necessarily bad. I don't think that the airlines today actually want as much supply as they did when they first ordered those aircraft. The environment has changed. And so to me, there being delays and being kicked to the right. It's now becoming more, I think that the industry in general is just being more aware of it, more realistic about the delivery profile of Boeing and Airbus at this point. So kicking it to the right is just another capacity constraint that's in the market. Even if you want to define growth, you probably can't. So that's more to the point of just the supply side of the equation continuing to be really constricted, over the long term. So, we'll see how the strike continues to play out. We don't have a real sound view on it. We know that they're voting on it soon. So we're going to see how that plays. But, the further it moves to the right, the further these deliveries are going to move to the right. So just going to constrain supply for longer.
So let's get to some individual stocks, Connor. Who do you think is navigating all of this the best?
Yeah, and I mean, in our opinion, that if Southwest is correct in that they're going to be able to increase, their overall operating income by $1.5 billion in 2024 to 2025, that's going to all flow up the chain scale. So the beneficiaries are the ones that can continue to still moderately grow and capture as others kind of start to rework their network and their product stuff. So from our standpoint, it's United and Delta. They've been ones we've liked for a long period of time and continue to like them today. They are navigating the situation much better. It's their plans is really just to continue to lean in on premium, the premium side of the equation that's done really well, while also offering a product that people want on the basic side that competes with Southwest and all the other ones. So if the smaller growth carriers are able to raise fares at all, it's only going to move up the ladder to Delta and United, in our opinion.
And Connor, United has ripped already this year, and it's up about 80%, but you think valuation is still attractive at these levels?
Yeah, the valuation, the numbers are working. This is a momentum space, always really has been. The revision side of the equation should continue. The idea here is that there's potential of $20 in earnings power. So if that ends up being the number, call it 2027 or at somewhere in that time frame, you're talking about just picking a multiple and then throwing it on there. And so there's plenty of upside going forward as long as these guys continue to execute. Again, the whole thesis here is that if Southwest and the Frontiers and the Spirits of the world start to fix their profitability, it's all going to accrete up. So yeah, the revision side of the equation should be quite good. Fuel's low. If we can continue to kind of keep supply low, there will be some pricing power. You'll get the double-edged, double opportunity from low fuel and higher fares going forward.
Do you want to, though, as an investor, any interest in getting in on those discount airline shares as well, or do you want to? It's still too risky at this point.
There's going to be there's still probably some pain going forward. The industry still grapples with a lot of these cost problems, and I don't know if that's fully appreciated by the market in general. Frontier has an open pilot contract. Spirit has a pilot contract that's going to come up soon, but they're also working through a lot of their debt that they have to deal with the loyalty bonds. JetBlue has an activist involved, but their story from our standpoint just remains a little bit more challenged. They need to again figure out who they are as they right size their network. So there's some more pain points going forward. And again, from our view, that if any of these guys are successful, if JetBlue is successful, it's going to help, Delta in Boston, for example, Delta in New York. So from our standpoint, the earnings torque remains at the ones that are navigating the environment a little bit better right now.
Connor, thanks so much for your time and those picks. Appreciate it.
Thank you.
And coming up, GM shares riding higher today on the back of their latest earnings report. We're going to break down the numbers on the other side when market domination returns. Wall Street cheering on General Motors' latest quarterly results, the automaker topping third quarter revenue and profit expectations. GM CFO Paul Jacobson telling Yahoo Finance on the optimism in the company's momentum.
We're building vehicles that customers are flocking to. We're picking up share. We're discounting less than most of our competitors. And that's been a consistent theme for the last several quarters. So we're just excited about the momentum we have in the portfolio, not just in our ICE, but also in our electric vehicle portfolio and what we're building there as well.
GM seeing EV sales rising 60% year over year in the third quarter. The automaker keeping its sights set on EV profitability. For more on where General Motors stands in the auto space, we have Morningstar U.S. Autos equity analyst David Whiston. David, good to see you. So GM, listen, they beat on the top and the bottom. The stock is soaring here. What did you make of the report, David? Give us your take on the results.
Yeah, it's another really strong quarter with a stock that honestly just doesn't get enough credit for what they've been doing for quite a long time with great product, as Paul was talking about in your interview with him earlier today, and most importantly, really strong pricing. That's been a big fear with really both GM and Ford stocks since late 2022, that full year 23 and full year 24 would see really large pricing headwinds after really large tailwinds due to the chip shortage, reducing inventory so much. And that just hasn't happened, frankly. And part of that is mixed because GM isn't in small cars, but also, honestly, they have really good product and it's in demand, and people who are buying new cars are on the wealthier side right now, and they're paying for it. And GM can do this and keep their discounts down, which helps earnings.
Some people are noticing, David, because GM's shares are up like 50% this year. So we have seen some money come back into the name and, that sort of recognition. At the same time, pretty much all the other automakers have not risen like that, to say the least. Whether you look at Ford, whether you're looking at the European automakers that trade here or elsewhere, what do you think, besides that sort of customer profile, what do you think from an execution perspective GM is doing right now?
They're controlling what they can control, and particularly around costs. They've talked a lot about reducing fixed costs by $2 billion out of the D&A increase. They've been continuing to cut capacity. That goes back even to action pre-pandemic. But the other thing they're doing that's helping the stock is about a year ago they announced a massive ASR, accelerated share repurchase of $10 billion, and the stock has rallied considerably from the 20s now to over 50 since then. But they've kept the momentum up by delivering strong results, especially with this quarter. The 10% increase today, for example, with the stock, it's a luxury being an auto analyst to see that. Honestly, it doesn't happen very often.
David, what about GM's business in China? I'm just curious what you're seeing now and what do you expect ahead?
Yeah, China is definitely a sore spot, though, for GM. That was very clear with Q2 results in July, and I made the decision at that point to just go ahead and make them prove to me that they can show profit rather than say things will turn around in a year or two. I'm just modeling losses in China for all of my 5-year explicit forecast period in our model. And hopefully they'll prove me wrong. But what's going on in China basically are things that are permanent, that are secular. In particular, the Chinese are moving towards Chinese brands now, and that's not a fad. That's not going to reverse itself in any way. And EVs there are huge, and GM's really been rolling out a lot of EVs in North America. They've been slower in China, which is a shame because Buick, for example, has a very rich legacy there going back nearly 100 years. So they need to catch up there, and that's going to be hard to do against the likes of BYD and many others.
David, while we're talking about international markets, I'm curious about tariffs and any effect that you're watching for linked to the election or otherwise that could have an effect on GM or other U.S. automakers.
Yeah, and I think that's, the tangential element with that is who's going to be the next president, and then what is the trade policy going to be under the next presidential administration. I think either way, you'll probably see a lot of protectionism trying to keep the Chinese out. That only works for so long, and the question, because ultimately the Chinese, if they really want to come here, they'll just have to get around the tariffs by opening up plants in the United States. For now, the fear is they're going to use Mexico as an export base into the U.S., and Trump has been very clear that he doesn't want to let that happen. I don't think a Harris administration would be wanting to see that either, and you've already seen the Biden administration put the tariffs on what very few vehicles come from China directly into the U.S. today. Then there's the whole USMCA trade agreement element here, because you're not supposed to have tariffs if it's made in Mexico and meets content requirements and labor requirements. But Trump is, I think, basically saying, I don't care about that. And also the next president will get to do an amendment to USMCA, so we'll have to see how that all plays out, and that just leaves a big question mark right now.
All right, we'll bring you back to help us walk through that as well. David, thanks so much. Appreciate your time.
Thank you.
And while we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
The closing bell on Wall Street, and now it is Market Domination Overtime, sponsored by Tasty Trade. We are joined by Jared Blicker to get you up to speed on the action from today's trade. Let's see where the major averages ended up. The action wasn't much there. It was mostly under the surface. We did see the Dow by the end of the day gain 62 points. It's kind of near the highs of the session here. The S&P 500 not even up 0.1%. The Nasdaq, the leader of the day, up about 0.25%. We did see some of big tech do a little bit better. A lot of earnings movers certainly as well. Jared's been watching all of it, and he's got a closer look for us. Hey, Jared.
Thank you, Julie. Just wanted to highlight, too, we had the major indices just barely climbing into the green for the close, some of them closer than others. Russell 2000 small caps underwater yet again. And also the bond market was catching my eye. And then we'll get into some sector action. Here's the 10-year T-note yield up to 4.2%, another 2 basis points higher than yesterday. And yesterday was a big day, too. So potentially headwinds from that on the horizon, though a little bit probably too soon to call that just now with the rate only at 4.2%. But staples in the lead today, followed by real estate and energy. To the downside, industrials led down by, I believe it was GE Aerospace and Lockheed Martin. That was the worst performing sector, down 1%. Materials also down 0.8%, but not seeing a lot of outsized winners or losers from there. And you take a look at the leaders, cannabis doing well today, so was China and regional banks and solar as well, but not in a big way. And then aerospace and defense, ITA, that was the biggest loser to the downside, down about 3%, seconded by home builders. Guys.
Thank you, Jared. Stocks recovering losses and managing to close the day higher. The tech-heavy Nasdaq rising for the 5th day in a row here. For more on the latest moves, let's now bring in Stephen Whiting, Citi Wealth Chief Investment Strategist and Chief Economist. Stephen, it's good to see you. So you say here that by early next month, much of the world will be gripped in U.S. election frenzy. And I don't disagree with you, Stephen, but what does that mean for viewers right now who are listening? What's it mean for investors?
Well, I would look at it this way. In the last 2 U.S. election nights, same cast of characters with the absence of Joe Biden, the range on U.S. equities over the election evening was about 6 percentage points. U.S. yields, you report on up a couple basis points. They've ranged nearly 30 basis points over the course of a day. So there's a time in which markets are going to try to very, very quickly absorb the implications of what U.S. policies will be as they guess and perhaps at who is elected president, what Congress that person will have. So this is the type of thing that you'll see. And what we really would be looking for as true long-term investors, and I would imagine, again, many of your audience, is if anything gets greatly exaggerated. If there's too much pessimism, too much optimism, that's the sort of thing that you can take advantage of in the aftermath of election results. There are other ways to think about this, but I would also just emphasize that global markets, international equity markets, may move even more than the U.S. does because of the impact of U.S. policies are very different between the two candidates.
And so, Steve, when investors are trying to figure out how to take advantage of this, one of the things that you recommend is sort of going long volatility, I guess, at least right around the event here. What's sort of the best way for people to think about that and do that?
Well, again, for suitable investors, you can think about the fact that the implied volatility on the S&P 500 is expected to be very high for that one night I mentioned, but it's expected to fall quickly after. Hedging costs are pretty low now for a period where the S&P 500 is near a record. Of course, we also have record corporate profit levels at the same time. So it's not that it really lacks an anchor. And then the other side of it is just using that volatility as an income source. If volatility surges, it's usually not able to hold that level for a long period of time. So especially if volatility is pushed out over a longer period in terms of the options market, then what happens is that there are techniques, again, for suitable investors to take advantage of that and use that for entry point management, use it as a source of income.
Steve, we've talked to a lot of people who have said, okay, if it goes this way, you can do this. If it goes that way, you can do that.
Right.
And we are obviously following the headlines that might affect the markets closely. One of the latest today, a report in the New York Times that Jamie Dimon was sort of a closet supporter of Kamala Harris. And even, his name has been floated as Treasury Secretary before. This was something else that was mentioned in that report. Something like that, does that affect markets? If it happened, could it affect markets? How do you think about those kinds of headlines?
It's a little hard to disaggregate. We just had, for example, strong employment report, couple mild positive surprises on inflation. And you know what? Longer term inflation expectations have risen 30 basis points. But it's also been as various polls and indicators have seen Donald Trump's prospects improve in his election probability. So it could be really very, very difficult, again, for investors, to rely on this information. How have polls really done for us? And that's why you get these big election night volatility spikes. And again, I've got to stand away from that. We've taken somewhat less risk in global equities, in non-US equities, where we have a bit of an underweight and we have a significant overweight in US equity themes, partly on the risk of what might happen with tariffs and other policies that are possible. But we'll take a look at that after the election result. If those things are, if we have some relief from all of those concerns, then it's possible again that we could shift those allocations. So I think again, relying on the polls, thinking that we can outbet the market on, who will win, that's not a risk that we want to take.
Stephen, let me get your take on this earnings season. We heard from the big banks, generally solid. Now big tech is on deck. Interested to get your thoughts. What do you make of this earnings season so far? And what do you forecast even for corporate profit growth ahead?
Well, it's broadening gains across industries. We came into this year overweight the S&P 500 equal weight, overweight growth stocks and mid and small caps. Specifically, again, it doesn't mean every small cap. It's not about, leverage low quality companies. But the idea that we'd have more industries that could grow their earnings is, what we've counted on. And now you could take a look at the S&P 500 equal weight index and its return over the last 12 months. It's about 35%. Now, are there some industries that have improved more? Sure. But what we saw in the second quarter is that 9 out of 11 sectors posted EPS gains. We might be 10 out of 11 by the end of this year. And it's not that we're going to have a 40% EPS gain or something like that as if we were coming right out of a recession. We're not. But again, broader gains across more industries because 2023 was a lousy year for many companies. Again, excluding the Mag 7, it was a minus 7% year for S&P 500 EPS. So that is allowing us, again, to see so many industries that have, in fact, been affected by monetary tightening in 2022 and early 2023. We think we can emerge from that and into the coming year. Again, it's not necessarily double-digit gains for the broad index EPS, but it's a lot more widespread gains. And in fact, under some circumstances, it might be a little bit more global.
Steve, great to see you. Thanks a lot for joining us.
Thank you.
Well, speaking of earnings, let's turn now to Texas Instruments. The company's third quarter numbers just hitting the wire. The share's fluctuating a little bit here. But let's get to the forecast first, because the company's forecast is for revenue of $3.7 to $4 billion. That's short of the $4.08 billion that had been estimated. Third quarter revenue at $4.15 billion. That's basically in line with estimates. Third quarter earnings per share about 10 cents above what analysts had been predicting. So it looks like the third quarter pretty much in line to slightly above. It is the fourth quarter forecast that might be causing some concerns here. The shares did fall quickly, but they've come back kind of to the unchanged line right now. TI is one of these companies we watch that is not so much in the AI conversation because they provide chips that go into almost everything, a lot of different analog uses. Analog revenue, by the way, at $3.22 billion for the company.
Yeah, CEO saying here that revenue decreased 8% from the same quarter a year ago, increased 9% sequentially. Industrial, calling out, continued to decline sequentially while all other end markets grew. And that's what you really want, more color and commentary about those end markets. And it's really autos and industrials for the same. They combine for around 70% of revenues. Autos are going to be especially interesting, I think, on the call, just given the number of negative pre-announcements, Julie, that we've been talking about, named Stellantis, Mercedes, et cetera. So what do they see there? They're calling out industrial segments, so you're going to get a lot of questions on that on the call. Updates on China are going to be front and center as well.
Yeah, and they don't. Their statement is relatively sparse. We don't have a lot of color as to why the forecast is where it is. So indeed, that call is going to be very important. Well, coming up, McCormick hosting their Investor Day this afternoon, and Brian Sozzi sits down with the spice manufacturer CEO Brendan Foley. We'll hear from him on the other side. Stick around, more market domination overtime coming up.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator.
Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Starbucks reporting preliminary fourth quarter and full fiscal year 2024 results moments ago. The company had been set to report all of its numbers next Wednesday. You see the shares dropping a quick 4%. Yahoo Finance's Brooke Obama covers the company for us. These numbers do not look good from Starbucks.
Absolutely do not look good. And Brian Niccol really stepping in, having to tackle this what is a mess right now. We're getting these preliminary results from the company. We saw global comparable same-store sales growth, that is, decline 7% in the latest quarter. Revenue coming in at $9.1 billion. In the U.S. alone, same-store sales declined 6%. That was driven largely by a 10% decline in foot traffic. We did see the average increase about 4%, though, year over year, but China continues to be such a sore spot for them. We saw same-store sales down there 14%, largely driven by a decline in foot traffic, as well as the average ticket. They were citing intense competition. We know that has been going on from Luckin Coffee as well, the others in the space there. They also said that they're seeing a soft macro environment in China as well.
So what is the game plan here, Brooke? What is the strategy to turn this around?
Yeah, well, Brian Niccol has yet to really set out on a strategy, but what we do know is that they are doing less promotions that we had in the past over the summer. They introduced that, the croissant along with the coffee, that $5 or $6 deal. No more of that. They're really doubling down on, they had a bunch of in-app promotions. They increased their marketing, but then it hurt them. It didn't really do well for them, it seems. And so Brian Niccol, a true marketing mastermind, of course, we have to lend a hand. Former Yahoo CMO was recently named global marketing officer there. Tracy Lieberman, she is set to start November 4th. And so certainly Starbucks just trying to abate this mess and really figure out how to get consumers back in the door, willing to spend and come back again.
Yeah, and I was just talking to Josh in the break. I went to Starbucks at an airport, for example.
Oh, me
I
too
feel
lately.
like every time I go to the Starbucks, it's kind of a mess.
Yeah, I have to say,
the complexity of the drinks, the time it takes, people are stacking up, waiting. It's a lot.
Yeah, I will say, I feel like the prices are also a bit heightened at Starbucks in the airport. And so I recently spent about $9 on their new pecan latte.
Wow.
I was really shocked by the price. I really was. But it just goes to show there is a value perception problem here. There is a foot traffic problem, people wanting to come back after they spent that money and maybe they waited in line a little bit too long. And these are all issues that Brian Niccol addressed in that first letter. Long wait times, value perception, and getting people to come back in the door. What's that cadence of marketing here?
And it looks like these same-store sales numbers that we're getting would be the worst since the pandemic. So definitely not something investors want to see. Thank you so much. Appreciate it. McCormick holding its investor day today. Yahoo Finance's Brian Sozzi spoke with McCormick CEO Brendan Foley on the company's outlook. Take a listen.
We spent our time talking with investors today about our outlook on the growth of the flavor market, our growth strategies, and also was an opportunity for us to really present what's an amazing management team that we have. We spend a lot of time making sure investors understand that we're a very different kind of food company. We don't really compete for the calories, we flavor them. And McCormick's a growth company.
That's a good tagline. So let's talk about how consumers, last time I saw you a couple months ago, got the sense consumers were shopping these supermarkets a little differently. And since then, we've started to see some weakness of traffic in fast food restaurants, I think because prices are too high. But what are you seeing in the shopper when they go into the supermarkets?
We still see consumers right now, shopping the perimeter of the grocery store. They're buying more produce and protein. And, they're in many ways, using that to kind of create their meals at home. And that's a good opportunity for our categories like spices and seasonings and condiments and sauces. And so, we really think that that's been driving some pretty healthy growth for us. But whether it's at home or away from home, it's an opportunity for McCormick because we really flavor every occasion.
Are you seeing a consumer gravitate to more affordable products?
We think consumers are looking for value all the time, and they're not going to sacrifice on flavor. And so we make sure that we offer a very broad product range, whether it's value price points or premium price points or a range of sizes. And so we see consumers really going to larger sizes, but also going to smaller sizes. In this search for value, we think we're doing a really good job of delivering on that.
Are those mini bottles of hot sauce still in demand?
Yeah, they are. It's a great way for us to create trial with just really not much risk. For $1, you buy this sort of mini trial size, and you could try some of our new flavors for Frank's Red Hot. It's a great way to kind of try it, like new creamy buffalo sauce, which we're launching. And it's really getting a lot of trial, and so people will start to trade up to larger bottles.
We're starting to hear, Brendan, a lot of retailers now cutting prices. Walmart is always going to be Walmart. They're always cutting prices. But Target is out today, at least, announcing 2,000 more price cuts specifically on food. Have you heard from Target? What is the impact of those more, affordable price points on companies like yours?
I think about what we've been trying to do in 2024 is meeting the consumer with where they are. So we took a very hard look at our total portfolio to make sure that we were driving value in all the areas that would be important for consumers. So we've already taken some action in many ways to make sure that we have affordability across our product line.
I recently caught up with PepsiCo CEO Ramon Laguarta, and I think he is inclined to putting products back in bags, giving people more. The product that they took out of the bags in chips and snacks during the COVID pandemic, what a lot of people call shrinkflation, that might be ending a little bit. What have you done in that area? Are you putting more back in your products? And then even secondarily, did you cut the sizes of products?
I can only speak for McCormick, but we didn't reduce package sizes to avoid price increases. What we really have done is really focus on looking at making sure we have a really broad product line for consumers to choose from. And we think we've been pretty successful with that. In this last third quarter, we reported that we really turned the corner on driving volume growth across our business. And I think that's a reflection that we're doing the right things in the marketplace right now to meet consumers' needs.
Has inflation started to ease?
Right now, I think we're seeing inflation still kind of, as we've reported, sort of in those mid-single digits overall. But, it's still something that we watch and we try to plan for with our productivity programs.
Help us understand what you're seeing in let me go back to the hot sauce category. When you guys reported earnings a couple weeks ago, it sounds like there's more competitive forces. What's happening in there?
Well, that's the one thing about operating in great categories that have a lot of growth. It attracts a lot of competition. And so certainly that's true in the hot sauce marketplace. And so we've been focusing a lot on making sure that we're really driving a lot more increased innovation. We're certainly supporting our brands even more aggressively than we have in the past. And so that's doing a lot of good. We're starting to see, really our underlying trends are performing pretty well in that market. But I would also say even in spices and seasonings, they attract a lot of competition too, but yet we're still performing a growing volume. And we like the way we're performing right now.
Of course, your predecessor made a series of really big deals that changed the complexion of the company or added to the complexion of the company. Is there anything on your plate, no pun intended, that you may want to do acquisition-wise?
Well, acquisition's been part of McCormick's long-term growth algorithm for a long time. And what's important for us in any evaluation of opportunities out there is that they really strategically meet our vision of being an even stronger flavor company. So it has to meet that vision of being in flavor, and we look for the right opportunities there. I would say right now that we still are looking and making sure that we're active in the marketplace, but it's got to serve that strategy.
And I can't help but ask, in the final time we have together, some of those products, are you making even hotter hot sauce?
We are. One of the things that we do a lot is we spend a lot of time understanding what consumers are looking for, and there's a big loyal base of Cholula lovers out there. But as we started really coming through, in fact, we used sort of generative AI to really understand where all the commentary was going. We learned that there were some Cholula lovers out there that wanted a hotter version. And so we're launching, coming in January, an extra hot version of Cholula.
And then I know you've added some other flavors into your market. Is this just that the consumer doesn't want to, they don't want to eat out, and they can't afford to eat out anymore, so they're reinvesting in their kitchens?
Well, this is one thing where consumers are looking to explore flavor. It's very exciting for them. As we look to the holiday season, there's a lot of excitement going on right now around our business. So it's a big time of year for us. But we also chose to launch this new product line called Finishing Sugars. And it's really driven a lot of excitement. And what people are doing is they're using it to kind of flavor their coffee in the morning, or they're using it in baking. And it's really driven a lot of excitement. I mean, I'll just give you an example.
Yeah, what's a finishing sugar?
Candy cane here. Yeah, these things have, or these products, I would say, have been really exciting. Salted caramel. This has really driven a lot of excitement in the holiday season. And so it's a lot to look forward to, I think, as you think about gathering families around this big time occasion.
I'm always amazed by the things you create and a lot of your competitors create. I mean, it's just a constant wheel of innovation. Brendan Foley, good to see you. Thanks for making some time for Yahoo Finance on your big investor day. We'll talk to you soon, and happy Thanksgiving if we don't talk to you.
Thank you. I appreciate it.
The International Monetary Fund said Tuesday that the global economy is on pace for a soft landing this year and also for 2025. But the upcoming presidential election could create some concerns. Yahoo Finance's Jennifer Schonberger is here with more. Hi, Jen.
Julia, I was at the IMF World Bank fall meetings earlier today, and I heard that everyone is worried about potential tariffs that Donald Trump could impose if elected as president and what the impact could be on the global economy with the U.S. election just 2 weeks away. I sat down with IMF chief economist Pierre-Olivier Gourinchas to discuss how the IMF sees the potential impact of more across-the-board tariffs on global growth and inflation. He told me the fund estimates it would result in a 0.5 percentage point drop in global output by 2026. Take a listen.
What is really happening is that you have this sort of weakening of the global economy, and that weakening of the global economy is the first order effect. Now, in terms of the persistence of the effect, it's certainly the case that we're seeing them in our scenarios. We're extending them until 2029. If we have higher tariffs, that's going to depress output permanently.
Now, when it comes to the impact of tariffs on inflation, Gourinchas told me it's a more nuanced picture, depending on how and when those tariffs are imposed. For instance, are your own goods being tariffed? Are you putting tariffs on imports? So in certain cases, countries could see an uptick in inflation, whereas in other cases, growth could be depressed and there's less of an inflationary impact. Guys?
Thanks, Jen. Appreciate it. Stick around, more Yahoo Finance coming up after this.
We are just 2 weeks away now from the presidential election. For more, let's welcome in Mark Cuban, co-founder of Cost Plus Drugs. Mark, it is great to see you. The election just a couple weeks out now, Mark. Interestingly, the polls show that what we see here is that they continue to tighten, Mark. And I'm interested in what you make of that dynamic.
You know, if you put it in context, Kamala Harris just got into the race 13 weeks ago, and she had negative favorability, low visibility, and was way behind. And so for her to catch up in 13 weeks against somebody who is the prior president, ran last cycle, been running this entire cycle, that says a lot. And I think she's actually going to pick up some momentum here the last 2 weeks.
Mark, it's Julie here. It's great to see you.
Hey, Julie.
You've been out on the campaign trail with her, which is a new thing for you. So I'm just curious what your impressions are, what you're seeing as you're out and talking to people, and whether do you feel like that's giving you a sense of what's going to happen, or is that sort of skewed because you're talking to people who are probably her supporters already?
Well, actually, I've been talking to small businesses, and I've asked specifically to have independents, undecideds, and Republicans in the audience because I wanted to answer their direct questions, and that's exactly what I've done. And once I get a chance to talk to them, they're sold, of course, but I think, the goal for my going out there is to help people realize that Kamala Harris is pro-business. She's really gone to the center. She doesn't have some left-wing agenda or anything like that. In many cases, she's far better for business than Donald Trump. And I'll give you a perfect example. Healthcare. Donald Trump says he's got a concept of a plan, but the reality is the second largest expense item for every business in this country is healthcare. Kamala Harris has said, you know what, we're going to go after the pharmacy middlemen because they're jacking up pricing and increasing costs. We're going to introduce transparency. And I know from my own personal experiences in the industry, that's going to cut costs by 20, 30% for individuals, particularly those with high deductibles, for companies that self-insure, and it has a huge impact. And so when I bring that up, and then they'll also bring up inflation, and that's also a counter to any inflation that they faced the last few years. So it really makes a huge difference to just get in there and answer their specific questions. And I think we've picked up a lot of momentum as a result.
Well, Mark, President Biden was making the case, and Vice President Harris was making the case as well that the administration was making progress on things like inflation and was good for the U.S. economy. That message was not getting through. Do you think that business people like you, CEOs like you, are going to make a difference here in the waning days of the election? Is that what the public needs to push it over for Kamala Harris?
Yeah, I really do, because it's such a close election. 2,000 votes in Pittsburgh, 5,000 votes in Phoenix. That can make the absolute difference. So every vote matters. And so going out there and talking to people, particularly businesses, and answering their questions, that's what I do. I mean, I've started, I don't know how many businesses, invested in hundreds. So I really can understand and relate to every type of business that's out there, just like I've done on Shark Tank. And so being able to answer all their questions within the context of the Harris policies, that's a huge benefit and a huge help for them.
I'm interested, Mark, why you don't think she's polling more strongly, why you don't think she's actually running away with this thing. The economy is decent. The stock market is working. People look at their 401ks, they're happy. Inflation is moderating. Why can't she close this thing?
Well, it's not that she can't close it. She's only been doing it for 13 weeks. Think of a new CEO who just took over a company and revitalized the products. They're not going to just immediately take off. You got to get out there and communicate. But as I said earlier, Josh, I mean, to be in this thing for 13 weeks and to take on a candidate and former president and to be in the dead heat at worst, that says a lot about the right things she's doing. So now for these last 2 weeks, all we've got to do is get those few thousand extra voters up to speed on our policies and how ethical and honest and open-minded, not an ideologue or dogmatic she is, all those things that really differentiate her from her opponent. We just have to go out there these last 2 weeks and look at it like the playoffs. These are the games that matter these last 2 weeks.
And Vice President Harris has you in her corner. Obviously, Donald Trump has Elon Musk in his corner, and you guys have been going at it a little bit on Twitter here. Do you think that he recently said he's going to give money away to people who are registering to vote? Do you think he should be investigated for that? Do you think that's okay?
I don't care. I really don't care. The only reason that you do it is because you're desperate. You don't go buy votes or buy registrations or get people to sign a petition because you think everything's going great. And plus, it could backfire. I mean, it's kind of insulting to tell people the only way we think you're going to register and take part in your civic opportunity here to vote is if I give you a chance to win a sweepstakes. That's insulting. And, people in this country are smart.
Mark, I'm just curious, Elon Musk is involved, but you're obviously very involved too. Do you think, how enthusiastically you're involved, Mark? Is there risk there in that AOC, man, she blasted you, Mark, for playing footsie with this election, threatened a brawl with you over your comments about Lena Khan. Does your involvement pose any kind of risk for Harris-Walz?
Oh, I don't think so. I mean, the response I've gotten is good, and it's not like Harris-Walz campaign is dumb. They have me out here for a reason because I can relate to small business. I can relate to people who, who are entrepreneurs and trying to get started. So I can explain that $50,000 deduction for your startup cost, particularly when you're a pass-through company like Subchapter S, LLC, sole proprietorship. I can get into the details and really connect to entrepreneurs and small businesses in ways that few people can. So I think I'm a huge positive. And look, AOC and I have talked about all that. We're all on the same team. We don't have to always agree, but we're on the same team.
But speaking of Lena Khan, have you talked to the vice president lately about Lena Khan or Gary Gensler for that matter?
I've never talked to her about any position at all. I stated, I've talked to Lena Khan and I've told her exactly what I've said. What I told her what I said publicly is exactly what I said privately. That I think AI is the most important battle that we're in, if you will, and that breaking up big companies is a threat to, our ability to stay dominant in AI. But I also have said that I think what she's done against PBMs and the pharmacy benefit managers, what she's done against scam companies, what she's done for click to cancel. These are things that are amazing, but it's just how I prioritize.
Would you want a position in a Harris administration? SEC chair, for
whatsoever.
example, something that has been
No, that
floated?
was just me trolling. That was me trolling. No interest in SEC, HHS, none of that. I mean, what I'm doing with costplusdrugs.com is changing the pharmaceutical industry. We're saving patients millions and millions of dollars, and that's something I'm really proud of. And I think I can have more impact on healthcare from that direction.
So speaking of maybe another cabinet position, not for you, but for another business leader, there was a report in the New York Times today that Jamie Dimon is sort of a closet supporter of Kamala Harris and would be interested potentially in a Treasury Secretary position. You think that would be good for America?
Yeah, I think it'd be great. I'd love Jamie, and I think he'd do an amazing job. I think just having the conversation with him sends the message that Kamala Harris is a hardcore capitalist, that she wants businesses of all sizes to grow. She understands that if we're going to reduce the deficit, we not only have to cut costs, we not only have to improve efficiency, but we have to know how to grow the economy. And that's something Jamie has proven that he can do with his companies and in helping others.
So you're not talking to Harris-Walz about positions, Mark, but how often are you in contact with them about different policies?
Every day, couple days, depending on what it is. I mean, they're sick of hearing from me on different ideas to support business and entrepreneurship. I think I bring a unique perspective, and they've been very wide open to it. We were talking about taxes as an example. I told them that, the idea of a tax on unearned capital gains was insane. And, it went from being part of Joe Biden's budget and never being proposed by anybody to not being discussed at all. And I think that's, maybe it wasn't me that brought it on, but it's a huge win. I've talked to them about, taxes, individual taxes. And one of the cool things that in the conversation we had was, there's 33 million businesses in this country. 99+% of them are small businesses. 99% of those are pass-through businesses, sub-S, LLC, sole proprietorship, et cetera. And of those people, 98% make $400,000 or less. And so we got down to the nitty-gritty to help people realize and help them realize that by sticking to $400,000 and saying that those taxes are not going up and there's a good chance for 100 million people they're going down, that helps small business. And I think I helped them to understand that. Same with tariffs. There's strategic tariffs, and then there's understanding the disaster that across the board tariffs from Donald Trump would do. I mean, and the impact they'd have on small business. If you think about it, at this time next year, if Donald Trump is in office and he's instituted a 60% tariff on Chinese goods, well, most of the things we buy are made in China, the backpacks, the sporting goods, et cetera. And so Christmas time next year, if you're having to make decisions on what you can and can't afford and everything's gone up 60%, you're going to have to cut way back on what you buy for Christmas. And if you cut way back on what you buy for Christmas, all those vendors, the dress store down the street, the sporting goods vendor down the street, they're in trouble. They may go out of business because of Donald Trump's tariffs. He says it's a negotiating strategy. He ignores the fact that the minute he starts talking about them, small and large businesses have to make decisions. They may have to say, I'm not going to invest in a new plant. I need this capital to go hoard products before they go up because of the tariffs. I'm not going to invest in hiring people because there's such instability about pricing for the products I'll be bringing in. My sales may go down. And we saw that happen in 2019 when he introduced tariffs before and got his butt kicked by China in those negotiations.
Well, and he's talking about a lot more tariffs this time, as you know. One other idea I want to ask you about is one that, again, comes from the other side and comes from Elon Musk, where he's talking about this Department of Governmental Efficiency that he would run. What do you think of that as a concept?
You know, this is one conversation I had with the vice president, and that's about using technology to improve efficiency of government agencies. And from the perspective of how do you get more results down to the people who need them? How do you get more services down to the people who need them? And efficiency is core to that. And so, you know, whether it's the vice president and her administration doing it, or it's Elon Musk, efficiency is a good thing. The question becomes, are you just going to take a sledgehammer and just tear down departments? That's a whole different thing. Now you're talking about people losing jobs, people who get services that are dependent on them. You're talking about healthcare programs. You're talking about education programs. You can't just take a sledgehammer to that. And if it's Elon, yeah, he's a great entrepreneur. I'm not going to doubt that or contest that. But he's got a few conflicts. You know, what about conflict of interest? How is the Trump administration going to deal with that? Is Elon going to give up his other businesses? Is he going to say, no, I'm not going to do Tesla. I'm not going to do SpaceX, et cetera, so I can work on this? I don't think so.
Mark Cuban, great to have you on the show today. Thank you so much for joining us. Appreciate it.
Thanks, Josh. Thanks, Julie.
Stick around. Much more market domination still to come. Well, the election is 2 weeks away, and one topic front and center is regulation. That's where startup Esper is coming in. The company offers an operating system designed to help policymakers develop regulations. Esper is working with the NYPD as well as state governments, including Tennessee, Iowa, and Montana, among others. And joining us right now is the co-founder and CEO of Esper, Malika Moman. Malika, great to see you.
Thank you so much for having me.
So we mentioned what you do and who you work with, but let's maybe give us a real-world example. For example, you work with the state of Tennessee, right?
Yeah.
Walk us through what you're doing with them.
All right, well, governments make a lot of policy, and I think it was appropriate that Mark Cuban went before me in his last bit was talking about how governments have a lot of regulation.
Timing.
Perfect.
Yes.
It's like he teed it up for me.
Right.
But governments make a lot of policy and regulation, and for the end consumer of policy and regulation, you or I, it can be hard to navigate, right? Sometimes you're hiring consultants, lobbyists, trade associations, just to navigate the labyrinth of government regulation and policy. So we go upstream and actually work with governments and provide them an intelligent operating system, a system of record for them to manage and update their regulations so that it's in alliance with best practices. Most government policy making today is really additive. So instead of going back and reviewing what do we have, is it still working, should we revise our existing policies, they just continue to layer on and on and on more and more regulation. And of course that creates downstream consequences for you and I. What we've done in Tennessee is actually help them repeal and streamline over 40% of their regulations, creating a more business-friendly environment for Tennesseans.
So what's interesting about you all is that you'll work with red state Tennessee. You'll work with a blue state like my home state of California.
Yeah.
When you work with red states and blue states, red governors, blue governors, do they think about regulation differently?
I think the regulatory reform narrative typically is sort of like championed by the right.
For sure.
Right?
Yeah.
Cutting red tape, burn it down. But I think that actually blue and red states that we work with, we have customers in California and Washington State, all the way to Montana and Tennessee, like you mentioned. They all have regulatory reform goals, but I think the way they message it is different. So if you take occupational licensing, for example, that is a big regulatory reform platform. On the left, they're talking about making it more accessible and fair for people that are in underrepresented populations to get licensed in certain professions. And on the right, they're talking about removing barriers to entry. So on the left, you might hear like accessible, equitable, fair. On the right, you might hear making it easier to start business, economic growth. Same goal, just like different messaging. So that's what I've seen sort of in practice.
Who would you consider your competitors in this space, Malika?
Honestly, status quo. Like I said, government's super additive when it comes to policy making, and they're used to sort of using this cobbled together system of SharePoint, email, pen and paper, true filing cabinets to manage their regulations. So it's no wonder that it's really complex to navigate. Governments themselves don't have a great system of record for it. Those status quo, I would say, is the biggest competitor.
Last question quickly. I thought your story was really interesting. So first generation American, right? Afghan parents. You grew up in Arkansas.
I grew up in Arkansas.
You played the bassoon semi-professionally. Did any of that sort of inform your interest in this area?
I don't know if it necessarily led me to regulation per se, but I will say being a tech founder, playing bassoon and being in the classical music world taught me a lot about resilience and grit, which I think in building a tech company is everything.
Right, Malika, that was great. Thank you so much for coming in. I really appreciate it.
Thank you, appreciate it.
All right, coming up, diving into a few tickers that are trending after hours here. Stay tuned, more Ask for a Trend right on the other side. Qualcomm announcing at its Snapdragon Summit that Li Auto and Mercedes-Benz are featuring Snapdragon chips in future vehicles. And for more, we're going to bring in now Nakul Duggal, Qualcomm's Group General Manager of Automotive, Industrial, and Cloud. And also joining us in studio is Yahoo Finance's very own Pras Subramanian. Nakul, great to see you. Walk me through this news, Nakul. And I'm just, for viewers who are listening, what is it actually going to mean? What's going to change for the consumer experience inside the car?
Thank you, first of all, for having me here. Fantastic to be with you. We are here in Maui, and we've announced a few different things. The Snapdragon Ride Elite and the Snapdragon Cockpit Elite platforms are our latest cutting-edge, best-in-class luxury tier platforms. The rate at which the car industry is evolving, the amount of technology that automakers are deploying into their vehicles, the connection that the car has with its ecosystem, the rate at which AI is entering our lives, we think far ahead in terms of what we need to build for our automaker partners. And this platform today has received the endorsement of both Mercedes and Li Auto as our longtime customers who are going to be deploying with the Snapdragon Elite. What's happening in the car business today is to be able to build software-defined vehicles that have the ability to support AI for the future. And it is very difficult to predict what these applications will mean, what do you need to run locally within the vehicle, what's running in the cloud. So this platform that we have created allows us to be able to essentially prepare for the rest of the decade and receiving rave reviews from all of our customers.
So Nakul, I know I understand you're working with Google here, partnering with Google for Google AI and also with their Android Automotive, which is beyond just infotainment. Tell me about kind of concrete examples. Are we talking about the ability to say, hey, Rezi, book me a restaurant reservation, and the car automatically navigates me there to make it on time? Is it also, I saw the example you guys had where the car detects that there is a parking issue, and it'll drop you off at your location and then find parking automatically while you're in the location. Is that what we're talking about here?
Yeah. One thing maybe to realize just in terms of how technology is intersecting with the auto industry, you need so many large tech companies to come together to create these new experiences. Our partnership with Google, obviously goes back a long time in the smartphone space, but especially in automotive, we've been working and learning together in terms of how do we create the best experiences for our customers. And the announcement we've made today, we've been partnering on a variety of different cockpit and chassis platforms. We realize that as the car is changing, we have to work together to be able to bring best-in-class technologies that both of us have. How do we create that experience for the auto industry? How do we learn together? And how do we kind of build these platforms that can keep evolving? AI, to me, has so many different applications. Of course, we know about safety and parking and all of that. But it really comes down to how does the car as a platform become an extension of your digital life, especially as the car is probably one of the more complex platforms. You have to be attentive. You are not supposed to be looking at your phone. You need to be able to communicate with the vehicle through your voice, through your gestures. All of this requires a tremendous amount of technology at the edge. That's what the digital chassis has been built for. That's what this partnership is about.
Nakul, I'll be honest, we've got chip analysts come on this show, and here's what they'll say, Nakul. They'll say it looks to them like Jensen Huang and his team in NVIDIA are simply running away right now with the highest performance AI. So how do you at Qualcomm, how do you differentiate?
Look, I think our history in automotive goes back a long time. We've been in this business 20 years. We have, I think, shared the size of the pipeline that we have built. This is a long-term business. It's a complicated business. The car is something that requires a tremendous amount of focus on not just technology, but the ability to deploy, the staying power, the global footprint that you need, the quality, the safety. And, I think with us, the number of customers, the number of automakers that bet on Qualcomm to design their next generation platform is evidence that we are actually probably one of the leading contenders. Obviously, it's going to be a space that's going to attract a lot of competition. But in terms of everything that it takes to build a car, I think we are in a pretty good shape.
So, Nakul, speaking of competition, does this platform allow for Apple CarPlay, which we know is very popular amongst a lot of drivers these days? And how soon can we see some of these AI tools roll out?
Absolutely. So the platform is actually capable of supporting really any ecosystem, any configuration, any solution that is out there. This platform is deployed across hundreds of millions of vehicles today. So I can bet you if you're driving a car today that you bought in the last couple of years, it's featuring our technology. Obviously technology races are very fast. This platform that we've announced today, we expect to see this in cars in the first half of 26. So we are moving really fast. The design cycles are getting short, and the pace at which AI, graphics, premium audio, the ability to be immersed in these new experiences safely, this is something that automakers are really wanting to move forward on. So I think you will see a lot more, I would say, a lot more design activity on this platform over the next 12 months, and then we'll start to make some product announcements in 26.
And Nicole, I know in different parts of the world, like for instance Asia, there's more of a desire to have these tech-enabled features, more technology, more AI assistance in the cabin. It's part of their, as you said, digital life. But in the States, people want to drive more. They want to be more connected to the road. Do people here really want some of these tools? How do you convince the public who might be somewhat skeptical of needing more AI potentially in their car?
Yeah, I think this is a very good question, and I think you're right in that China has mature digital ecosystems that are broad-based and horizontal, and not necessarily what the rest of the world has. But to answer your question on AI, I feel like one of the things that AI is going to do right away for the car is to be able to make the data that lives inside the car available for the human to be able to communicate with. Let me give you an example. All of our cars have a tremendous number of sensors. Everything that you're doing in your car is being measured, whether it's your mileage, your road tread, your quality of driving, how your new teenage driver is doing. All this information is not accessible to the human. When you are sitting in a car and you're trying to understand what is actually happening, you have to go look up a manual, you have to go call the dealer. All of this is actually going to change because AI is going to allow the technology that is available in the vehicle to be accessible to the human at the edge. And obviously the automaker is going to have access to this. So we are getting tremendous feedback in terms of how do you rethink what you can deploy at the edge. This data is obviously private, it is secure, it has to be managed with the right level of latency. That's where we see a tremendous amount of innovation happening.
Nicole, thank you so much for your time today and insight. We appreciate that.
Thank you very much. Great to be with you.
Let's take a look at what's trending after hours now. McDonald's stock sinking after the CDC announcing that 10 people have been hospitalized and one older person in Colorado has died due to E. coli infections linked to consuming McDonald's Quarter Pounder hamburger. The specific ingredient linked to illness has not yet been identified, but investigators focused on two ingredients in particular, slivered onions and fresh beef patties. The CDC said the number of people affected by the outbreak is likely much higher than what has been reported so far. McDonald's has removed the onions and beef patties used for the Quarter Pounder hamburgers from stores, and the items will be temporarily unavailable in some of the affected states. That's a wrap on today's Ask for a Trend. Have a great night.